This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's MINERALWARE.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about the oil price forecast for 2026 and a shocking new short-term energy outlook when you look at the potential for where prices are going to go next year, Justin.
Yeah, you said it, Matt. It was the EIA that released a short-term energy outlook, and it really came with a shocking plunge of about 26% in 2026. Which, I think that was a bit of a shock to the market, and the prices show as such.
Yeah, I think you're right. And, obviously from a mineral and royalty owner perspective, looking ahead and, looking at your royalty statements in those lower price environments, it's a little bit of a shock, especially with maybe some of the more stable and higher prices for oil that we've seen over the last couple of years. It's been a few years where, really since COVID, I'd say that recovery time period that we saw prices below $50 a barrel, and the latest EIA short-term energy outlook released on October 7th is forecasting that oil prices could decrease to under $48 per barrel in 2026. And so I think if this plays out as projected, it could reshape the landscape for drilling activity and our income, over the next 18 months or so. And so I think it's really going to be interesting to see what happens. Hopefully it doesn't play out as they're projecting, but what we wanted to do today was really break that down, talk about possible scenarios that could occur in this kind of lower price environment, what it would mean for us in terms of our royalty payments beyond the obvious, we're going to get lower royalties because the price of oil has fallen if we have a lot of oil production that we're getting royalties from, but really dive a little bit deeper than that and talk about some of the nuanced trends that might develop as a result of this.
Yeah, you said it, Matt, and conversation about how operators might, react to this. And it was a little surprising to me as we dug into this that my first thought is, okay, well, are other countries producing a lot with kind of what's going on in the geopolitical world right now? But really, it looks like it's us that's really been producing. And we had a bit of a conversation, Matt, before we hit record. The rig count, we would, in previous years, we would expect to see the rig count really going up, but that's not necessarily the case. We're producing more with the same amount of rigs. And so there's been a lot of supply coming out of the market from us and then some other players as well.
Yeah, that's a great point. I think a lot of that goes to the efficiency, which you're alluding to. We have increased efficiency. They're learning the secret sauce in terms of completing these wells and drilling them, longer laterals, more efficient completions means that the well productivity is higher for a given investment in drilling. And so what that means is we've seen oil prices actually reach all-time highs in 2025. In fact, there was some statistics, we'll put a link into this short-term energy outlook in the show notes, but they mention a few key statistics for U.S. production growth. And it is, like you said, Justin, it's really the U.S., it's Brazil, it's Canada, it's non-OPEC related countries that are actually driving this production growth. And I think the worry that prices are going to fall as a result of this oversupply situation that we find ourselves in. In fact, we're looking at around 13.5 million barrels per day production in the U.S. that was the average projected for 2025, and then that's looking to continue into 2026. Again, I think largely due to those efficiency gains.
Matt, one of the saving graces here is that the demand for natural gas is up. So that's a good thing. But with oil prices falling, I'm sure we're going to see some shift into where operators are focusing on. Right? There's situations where natural gas is the byproduct, and then situations where natural gas is the main product that they're producing. And we've seen a little of that, but I'm sure we'll really start to see more as time goes.
I think it's important to look at the current situation. And we have seen oil and gas producers reporting declining profits since 2022. Of course, 2022 was a key date with oil prices above $100 a barrel. So obviously they're going to have record profits and all those things. And so as the prices have gone down, those profits have dropped as expected. And what we saw really in 2025 is a further erosion of the oil prices down into the, say, $63 to $64 per barrel range, which was a drop of around 36% in operating earnings as a result of that decreased oil prices. And so I guess the bigger picture from a mineral and royalty owner perspective is that the oil and gas industry has been under pressure, again, because of those lower prices. And if we did drop to the projected $48 price level, I do think that would cause a significant decrease in drilling. That $50 per barrel number is seen as sort of a key threshold as far as a break-even point for certain basins for new well drilling. So in other words, if they're going to drill a new well, they need prices to be above $50 per barrel in order to be profitable. Otherwise, they're losing money. And so obviously, if you're running that business, if you're the CEO of an oil and gas company, you're wanting to protect the profits and make sure that you're not going to lose money. And so what you're going to do is make decisions to decrease investment potentially to offset those lower cash flows that you're bringing in. So, and I think we're seeing this with some of the major CEO sound bites, that have been released recently. Do you want to talk about that, Justin?
Yeah, absolutely, man. Which, like you said, it makes sense in business. And Total Energy CEO indicated that the non-OPEC supply, which includes U.S. shale production, will begin to decline if oil prices fall to 60 per barrel. So that's slightly higher, Matt, than the 50 that we've heard before, with more significant drops occurring at lower price levels. And this assessment from one of the world's major energy company validates that concerns that those prices going towards $48 a barrel are really going to trigger substantial cuts. I'm sure they're encroaching on the point to where it's just not profitable, and they would be producing at a loss, especially when they could focus on other areas and producing other wells.
Yeah, that's exactly right. And it was interesting that Total Energy's CEO quote at this Energy Intelligence Forum in London. He said that our view is that from mid-2026, non-OPEC supply will be much lower, no growth, and then OPEC will be regaining control of the market, which I thought was an interesting take. So right now, a lot of the production growth has been centered in non-OPEC countries. And as those profits decrease and they decrease drilling, OPEC, depending on how much pressure they want to put on the U.S. shale producers, if they continue to increase supply like they're doing right now, that could put the prices, below even where I think the EIA is projecting. Hopefully, that doesn't come to that. I think what more realistically happen is that they will decrease those production increases, production growth targets, maybe shrink production, in which case that'll help stabilize the market. But I think that what we're going to see is shale producers in the U.S. have been the swing producer, right? So where oil prices are higher and demand is higher, they're able to rapidly increase production in a fairly consistent manner. And as prices decline, similarly, they're able to scale back the reinvestment. And I think especially as these companies are really focusing on capital discipline, that would be the case. And I think there was another quote in this article we'll link to in the show notes that Ryan Lance, who's the chairman and CEO of ConocoPhillips, said that $60 to $65 a barrel WTI, the U.S. is probably plateauish, which is kind of where we've been, and that's what we have seen this year. But then he said if prices stay at 60 or go into the 50s, you're probably plateauing or slightly declining. So I think if you do go down to that, $48 a barrel, I do think we'd see a decline in production. And as we're recording this, we're actually below $60 a barrel. We're down to around 58, around 58.40. as of the 14th of October when we're recording this. So certainly has fallen, and I think there's a lot of headwinds as it comes to oil prices for next year.
You said it, Matt. Yep. And this is going to it'll have a major impact on royalty checks that come in. When a well produces 100 barrels of oil in a month and the prices are at 70 per barrel, that's $7,000 in gross revenue before any of the costs are deducted. If you own a 3/16 royalty interest, you receive roughly $1,300 from that production. But when prices fall to 48 per barrel, that same 100 barrels, the gross revenue drops to 4,800, and your royalty payment falls to approximately about $900. And so it's a pretty large reduction when we're talking about prices going that low, and then also staying that low for a long period of time.
Yeah, that's exactly right. And obviously that's assuming you had 100% of the minerals under that one well in that hypothetical example. But I think the main number to take away there is that prices dropping from $70 a barrel, maybe where they were earlier in the year, to $48 per barrel if it plays out in 2026. That's a 30% drop in oil prices, and a result of that, a 30% drop in the oil royalties that we would receive from that, all things being equal, same production levels and same decimal interest and all that stuff. So it's a big chunk of change that we would be expected to not see come in. And so I think it's important to understand this as you're planning for 2026. The way I look at it from a financial planning perspective, and don't take this as financial or investment advice, you want to be conservative, right? You don't want to go to the best case scenario. If all the stars align, this is what's going to happen, and I'm going to get this windfall. It's what am I going to be able to bank on, or at least budget, to make sure that I have enough money left over at the end of the day that I can pay the bills and I have a little bit extra to save. And you'd want to project your budget based on maybe that worst case scenario or the most likely scenario. And so I think it's important to understand what the experts are saying, what the market is saying as far as next year's oil prices. But obviously, do your own research and make your own decisions from that. But it's a data point to consider.
You said it, Matt, and we've talked about in previous shows that oil companies have been really disciplined in recent years, and even with the declining revenue and cash flows in the second quarter of 2025, producers have maintained their dividend payments to shareholders, and like you said, are reducing capital investments and acquisitions. And so if they receive more pressure, it looks like that's how they're going to focus. And it'll be interesting to see the different ways that operators respond. The folks that have a heavy gas presence for production seem to have a bit of an advantage over the folks who are mostly oil-based right now. So be curious to see if that means operators are going to move assets, trade assets, do acquisitions, or if they'll continue to live within cash flow.
Yeah, that's a great point. I think those large independent companies, the integrated oil and gas companies, the majors that have that diversity when it comes to the production mix, they aren't solely weighted on oil production. They can shift investment to gas. And the good thing, like we mentioned in our recent episode on the future of gas prices, but you can find the link to that in mineralrightspodcast.com, where we do a deep dive into the projected outlook for gas. And I think that is a very bullish story. So it's kind of interesting where you have this kind of sobering reality around what oil prices might do next year, dropping pretty significantly, versus natural gas, which is projected to go the opposite direction and actually be increasing and to be at much higher levels than they've been for the last few years. So I think there is a silver lining to all of this, and those companies that have that flexibility are going to use that to their advantage. Another way to take advantage of this situation is if you hedged a lot of the production currently, agreeing to sell oil at specified prices, in the future. Those futures contracts, basically, that provides a price floor for those companies, so they can continue to invest in drilling new wells and maintain a level of profitability needed. And so you might see some of those companies not make as many changes in their drilling activity, despite the lower spot price for oil. Like, the daily, if I had to sell it on the open market today at $48 per barrel, well, if those companies have locked in hedges at $55 a barrel, and that's above their break-even price, it may dampen some of that downturn and dampen the decrease in drilling for some of those companies that happen to have that as a strategy. And I think the other thing is it's going to be very nuanced in areas that have low cost. So areas that have already, invested in infrastructure. They have the gas plants, they have the gathering systems, all the things, and they're just incrementally drilling wells. It means that basically they can continue at a lower overall cost and more cost efficient situation. Whereas if you're in an area that maybe requires a lot of infrastructure build out, and you have to build the gathering systems, you have to put the processing facilities in, and you have to do all of that, that's going to be more challenged from a economics point of view, and you might see those projects get shelved first. So it's going to be, I think, totally dependent on the nuances around the economics in each individual basin, and then again the operator specific constraints, we'll call it, around hedging, what their mix of production is. In other words, how sensitive they are to low oil prices. And then from that standpoint, you can sort of maybe look at your specific situation, do some research on the operators that you're receiving royalties on, and we'll talk about how you can go and do that to find out maybe what they're thinking and maybe how this might affect them.
No, you said it, Matt. And, there's a couple different aspects to think about with this. There's the going out and drilling new wells, which, we're going to be very likely to see that slow down. But then also the declining production, like we've always talked about. If we're not producing new wells, then production's going to naturally go down as these wells decline. It'll be interesting to see what areas end up coming out ahead. We've talked about it with the rig count, that we've seen some shifting to different areas, and how much will the infrastructure make an impact, and how much will having an opportunity with natural gas being the primary really make the impact. In the West Texas area, there's wonderful infrastructure built out, so that's a pro. There is takeaway capacity for natural gas that can be an issue. They're typically going to drill oil. Are we going to see wells start to shift to other developed areas for natural gas?
Yeah, certainly. I think while there is a lot of associated gas in the Permian, so that means that's natural gas that's produced as a byproduct of crude oil, they're primarily going after crude oil. And so that means if the economic driver for that well is the price of oil, they're going to probably not drill it, especially with the Permian. The Waha hub prices have actually been negative for a large part of this year. So that means they're actually paying companies to take the gas. And so even though gas prices regionally or say across the country, the Henry Hub spot price for gas would be in the $4 range, they may only be getting $1 or less than $2 per 1,000 cubic feet. And so it's not economic for them to go and say, well, we're just going to continue to drill because the gas prices are going to offset the lower oil prices, because that likely won't be the case. Now, that being said, there are parts of the Permian that are extremely economic even at lower oil prices. So those sweet spot, we'll call it, we'll continue to see some investment just because they can still, generate a profit at those lower prices. But then the fringier stuff, the things that are maybe less developed, like you said, Justin, the supply infrastructure is not there, the takeaway capacity is not there. Those are going to get the first to get cut. And then you'll see those companies that they're, in addition to the very best drilling locations, they're going to look at across the entire portfolio, where can we invest, where we can get the highest profit, and likely those are going to be the natural gas plays. If they have assets in Appalachian Basin, in the Haynesville Shale as well, in East Texas and Louisiana, those would be the focus for maybe increased investment and then decreasing some of those less profitable oil wells. But yeah, I think that's going to really vary operator by operator. But I think when you look at the bigger picture, it's interesting to hear what the operators are saying. And I think there's some interesting stuff out there, like the Dallas Federal Reserve survey they do each quarter, I think it is, on the oil and gas executives. You want to talk about what the latest results of that survey are?
Sure, Matt. Yeah, so the Dallas Fed survey, it really gave us a good idea into what folks are thinking. So they regularly survey executives at oil and gas companies, gauge their outlook and plans, and it gives us some really good insight. Producers have become increasingly cautious about committing capital to new drilling, as you would expect, given the price volatility and uncertainty. Many companies are emphasizing capital discipline, which is industry terminology for spending less on drilling and returning more cash to the shareholders through dividend and stock buybacks. And for mineral owners, that philosophy can mean that even when companies have the financial capacity to drill more wells, they may choose not to in order to maintain a strong balance sheet. and satisfy the investors, which is what we've been seeing them do in the past few years. In a global stage, the way the oil price recovers is by having the lower price, which pushes the supply down, and that way it can meet demand again.
Yeah, that's a great point. I think that is something we mentioned before we hit record, that the global oversupply of crude oil, I think, was between 1 and 2 million barrels per day, based on the latest end of 2025 projections. So we are in an oversupply situation. So the question is how will the market respond? And again, just like Justin said, when prices fall, less investment, cash flow is available. So that means decreased drilling, which means lower production. Now it's I would say, a cycle that lags the decrease in price. So the price will fall, and then it'll take several months for production declines to occur, or that drilling to slow down enough to where it's starting to show up in production. Normally, we overshoot. That's why you see these boom and bust cycles, is because they're responding to those increased prices and drilling more, and then the prices fall once there's too much supply, and then vice versa. When supply goes too low and we're actually undersupplying the market, in other words, there's increased demand, more demand than supply, then you see prices rise again, and that's what triggers more investment. So it's sort of this kind of vicious cycle, if you want to call it that. But yeah, I think that when you look at the Dallas Fed survey, I think the key thing is that they see decreased investment likely, and it's interesting how they mentioned the thing in here about the labor market and service costs. And so you see the prices for the service companies, and those are the companies that provide the drilling rigs and the frac crews and things like that to complete the wells. They are setting their prices based on what the market is. And so similarly, they increase their service costs as the demand goes up, and they, hey, we can't, meet all of the demand for our services, so we're going to increase prices. And then vice versa, when they start laying down rigs and the frac crews are sitting there in the yard, they actually start decreasing prices to try to get those out in the field and to put them to work. And so I think what you'll see is a lag in that decrease. And so even if prices fall next year, it may take a little while for those decreased service costs to affect the economics of those new wells. And so again, that's pretty typical, where we see several months go by before companies renegotiate those drilling rig contracts or those frac crew contracts, and to be able to use those into economics when they go and propose a new well. So, I think it's going to be not a huge factor as far as the decreased costs once the prices go down, but it will eventually sort of shake out in the market, I think.
You said it, Matt. I think this is something that it's not something that happens quickly. There's not a super fast reaction to this. The companies are typically planning annually. And even in 2026, we may see companies fulfilling commitments they've already made. But we're going to start to see that decrease as the amount of wells that would have been drilled goes down. We'll start to see that the supply come down as well. And Matt, OPEC is always a big question. There's a situation right now where we're the top producer, which gives us some power in that conversation. But with OPEC, we never know exactly what they're going to do. They've surprised us before. And right now it looks like the United States is the largest portion of growth in the global supply. But OPEC companies and its allies still hold substantial influence over the oil prices through their production decisions. If the prices fall, that also pressures OPEC members, and the countries may implement production cuts to defend prices as well, which would benefit all producers, including the U.S. and mineral owners. However, OPEC's willingness to cut production, who knows where that stands currently, Matt? What was the mention from OPEC the last time we heard from them?
Yeah, they were still increasing production, and it's been slow. It's not like they're flooding the market, but it has been largely following the plan of, in 2025, increasing their production targets for their member countries. And that's largely played out. Now, I think what the consensus is if prices continue to fall, that they may start to decrease those production increases, or maybe hold production flat or potentially decrease production. In that case, that'll help support a recovery in prices. So ultimately, I think the U.S. and other non-OPEC countries are a little bit quicker to respond. They can, stop drilling wells and stop completing wells. And we'll talk about how that could play out. And that could be a factor as well, where companies might have some obligations they have to meet to drill wells, but they may hold off on completing them. And that's a whole whole other segment that we could cover in detail, but we'll mention a little bit about what that could look like. But, I think ultimately the end of the day, I think bigger picture, let's talk about mineral owner and royalty owner perspective. What is this going to mean for you? I think the big thing, like I mentioned earlier, is immediately it ought to be something where we're looking at this for next year's planning, budgeting. If our royalty income is significant portion of our overall income, it ought to be a good time to meet with your financial planner and to readjust your budget for next year and to say, okay, if our royalty income is down 25% or 30% in 2026, what do we need to do to balance the budget? Maybe that means putting off a large purchase or expensive vacation, but you got to look at the bigger picture, and then hopefully that doesn't play out as projected and you have a little bit extra cash to spend. And then the other thing, I think the bigger picture is if you have a mix of properties that have existing production, it's pretty easy to figure out what that's going to look like. If production declines, we can pretty accurately model that. And then the big variable is what is the oil price or the gas price going to do? And so we can look at that to see, how's that going to affect our royalty income? But then the other question is if we have properties that are undeveloped, that we've recently leased or that maybe have a lot of drilling going on nearby but haven't occurred on our property yet. Justin, what is the consideration there, and what does this potentially mean for those mineral and royalty owners?
Yeah, this can be a source of a lot of contention and uncertainty for mineral owners. These projects that even if they've gone out and leased, folks, the real cost there is drilling the well and getting that well completed. And so you may even have a lease, but companies may be prioritizing their producing from what they currently have and maybe delaying those projects. It's always a critical decision for companies what they do with leased areas. They try to maintain their leases, but they may absolutely take advantage of not having to do it in 2026 with these forecasted low oil prices.
Yeah, that's a great point. I think it could mean if you're on the verge of having a lease expire in the next 12 months, it may be that they don't drill a well to hold the lease. And so the upside there is you might get to lease again, in the next couple of years and get another lease bonus and maybe even get better lease terms and royalty rate terms that you negotiated before. So I think there is, even if a well doesn't get drilled, obviously time value of money, you want it to happen as soon as possible because that means, the value is the highest possible for your minerals at that point. But again, if you're holding this for the long term, look at it as the opportunity to potentially lease the property again. And then when prices recover and a well gets drilled, you'll get royalties that are hopefully higher because it'll be at a higher oil price versus if they just wanted to drill the well to hold the lease and they started producing at $48 per barrel. And in that first couple of years of production is when you get most of, the production from those wells, a third or half of the production over the first few years. And so you'd want that to occur, hopefully, in a higher oil price environment if it's an oil well, so that you can get the highest royalties possible during that time period. So for them, delaying drilling, it's probably better in the long run for you as a mineral owner. If you look at the overall value that you're going to get over the well life, timing is everything. And obviously nobody can time the market, but just if they happen to drill when prices are higher, you're going to get higher royalties. Just it's pretty straightforward. And so I think that's a big consideration.
Yeah, you said it, Matt. And like you said, throughout 2026, I'm sure we're going to see production continue, and those that have mostly gas producing properties may not be as greatly impacted as those who have heavily oil producing properties. So that's an interesting factor that we see with this, but it's setting the stage for a hard patch for the industry. And I'm sure there's going to be some adjustments, some shifting of investment, and some shifting of the areas where we're focusing. So like you said, Matt, maybe it'll create new opportunities elsewhere in other states to pull some of the infrastructure together and to get production flowing there.
Yeah, you're exactly right. I think that when you look at the things to look at, I think that if you're a mineral owner and you're wanting to monitor how things are developing, how is it playing out in real time, there's a couple of resources we'll mention. The first is that the EIA, that short-term energy outlook, and we'll link to that in the show notes, and that's updated monthly. and they provide ongoing insight into the current market expectations. So if something changes, they'll update that and say, okay, prices are going to, here's our new price forecast for next year or the year after. And then the other thing to look at is the Baker Hughes rig count. And so we talk about that each month in our news episode. We give an update on the rig count. And that's another thing you can look at to see. It's sort of a lagging indicator on what operators are doing in response to lower oil prices. And, as we sit today, we're at 529 land rigs versus 586 just a year ago. And the mix between gas and oil drilling rigs is right now at 120 rigs focused on gas wells and gas plays versus 418 focused on oil. So prices drop below $50. I would expect to see a pretty big shift from those oil plays to the gas. And so especially again, as those companies have assets that are both gas and oil, and they might shift investment to the gas, drilling gas wells. And so you might see a shift in that rig count. And so that's where you would look for that potential trend.
No, it'll be an interesting landscape, Matt. And there's so much geopolitically that can affect this as well. Something we were talking about a bit before we hit record is how much are the data centers in West Texas going to affect, how their decision to keep wells online there. Maybe that shifts the profitability for certain wells in certain areas. But what a interesting 2026 where we could see a world where the oil is actually the byproduct. These companies are beginning to focus really on the natural gas.
Yeah, that's a great take. I think that that is a big, silver lining for 2026. Like I mentioned earlier, there is a very positive outlook for natural gas prices. And while the EIA has brought that gas forecast price down a little bit, they still are projecting an average of $3.70 per million BTUs in 2025. And that's going to increase to $4.40 in 2026. Again, based on that same short-term energy outlook. So on the same token, they're saying gas is going to go up. And so if you have a mix of gas royalties and oil royalties, some of the increase in gas prices will help offset the decrease in your oil royalties. So that's something to think about. And then the other thing that could happen, and I will say this is probably going to be operator specific and basin specific, but there is a thing called a drilled and uncompleted well, or a DUC, DUC. And this is where an operator drills a well, but then they don't complete it right away. So they let it sit there before they bring in a frac crew. So maybe maybe they wait a year or more in some cases before they bring in a crew to go and complete that well. And particularly where companies have lease obligations that are, in a hot area, that if they don't drill the well, they're going to lose that opportunity. They may still drill the well despite the oil prices being lower, but they may wait to complete the well until prices have recovered slightly. And so you might see a rig show up, you might get the notice that the well has been permitted, and then they still go and drill it. Temper your expectations potentially on when you're going to get that first royalty check, because it may take a while. If they're letting those wellbores sit uncompleted, it could be a year or more before the frac crew shows up. And then, again, it's even, probably 6 months after that you might get the first royalty check. So you're looking at 12 to 18 months potentially delay until you receive that first royalty check. But again, the benefit from a mineral and royalty owner perspective is that you would get the well that's like a defined line of sight to sometime in the near future, some production occurring and getting the production and those royalties, but it just may be delayed. So that's something to think about. And that DUC count could increase. It could be a way for companies to maintain their drilling obligations. They have contracts that they negotiate with these drilling companies for like a year, and there's penalties if they don't meet those requirements. So they may continue to do the minimal investment possible to maintain those leases and those lease obligations, and also the drilling contract obligations. And from there, wait and use only the cash flow they have coming in. And that means just, decreasing what they can spend money on in that year. And there's ways to figure that out. If you look at publicly traded companies, they report quarterly earnings and they have conference calls and they have investor presentations. You can go to that company's investor relations page on their website, and check out their latest or last couple of investor presentations and see what they're saying to the market. What are they projecting capital budget spend? They'll announce that number and they'll say, okay, we're decreasing it by this much, or we've held it flat for this year. You can see what they're specifically doing as they report earnings each quarter. And so, if your royalties are being paid by a public company, that would be the first place to look. Justin, where are some other resources for royalty owners?
The Texas commissions are always a good place to look. You can see what permits might be getting approved and what permits are requested there, and also the drilled uncompleted wells. Matt, we just had the National Convention for the National Association of Royalty Owners. The talk was all of the drilled uncompleted inventory that operators have. So we might see more DUCs come up. We might see some of the DUCs being used to maintain the operations and maintain the production. NARO is a great resource. There's a lot of folks who are talking about activity and what's upcoming. The Mineral Rights Forum is a great place to see what might be happening out in the field. And Matt, I think we'll start to see in the different areas kind of how people are focusing by watching that rig count, like you mentioned. I think that'll give us a big picture as we kind of go through the year.
Yeah, I think you're right. And, I think there's other bigger things that could happen. I don't know that we're going to see a lot of mergers and acquisitions, but this can be a time where a company that's actually got lower debt can take advantage of those lower oil prices and gobble up some smaller companies that have a good acreage position that they can take advantage of when prices recover. So you might see some of those distressed or maybe more price sensitive companies get gobbled up by those companies with a little bit extra cash. Not probably something we'll see a huge run on that, but it'll be more isolated. I think the other thing is just ask your operator, right? So especially if you have royalties that are being paid by a smaller producer, sometimes you actually can get a higher chance of talking to some real person and find out what's going on. If you talk to the owner relations department, say, I want to talk to somebody in your land department, we're doing planning, and I'd like to understand, for these wells you have permitted or for this area that you're developing that you've leased my minerals recently, I want to know more about what your plans are. And sometimes they will share it. In fact, I had a client that I'm working with that I spoke with the landman, and it was a smaller independent oil and gas company that operates in East Texas in Haynesville. And, they had some permits out there, and they have this other area that they've, filed, one well in a large unit. And I was like, hey, what's going on with this unit? When are you planning to drill those additional wells? And they shared very openly what their current plans are. And again, recognizing that plans can change and if prices fall and all of that, you got to take that with a grain of salt, but you can learn a lot from just talking to your operator. So that's a great resource that I think is underutilized by mineral and royalty owners.
You said it, Matt. Yeah, and they would love to have that conversation over probably a lot of other conversations that they can have with mineral owners.
What are some of the questions that mineral owners should be asking, when it comes to, the bigger picture? What are the things to consider? What are the things that we should be looking at? And as we look at what might happen in our area?
Financial planning, Matt. I think that's the biggest thing is for mineral owners to realize that, they need to look at their budgets, ensure that they are prepared for what might be coming with the lower prices. Understanding what it is that you're really making money from, whether that's oil or whether that's natural gas, would also be a great thing to look at. And then, Matt, as you mentioned earlier in the show, speak with a financial advisor. This might be a great time to look at it, kind of everything, your whole portfolio overall, and see what you could do to balance it. Matt, oil prices, a lot of things can change this. This show might be completely obsolete in 3 months with new information that comes out or geopolitical things that change it. So keep an eye on the oil price as we creep into 2026 and throughout 2026 if this sentiment stays the same.
Yeah, exactly. And I think it's, it's very nuanced. I think knowing what you own and knowing how to research the property on your state's oil and gas commission website becomes even more important in these lower price situations. Like Justin mentioned with the Texas Railroad Commission, if there are permits, still getting filed in an area, that might indicate that the economics are still good, even at those lower prices, and maybe they are going to continue to drill. So that is something to know. And if you need help on knowing how to do that, we have lots of information on the website, mineralrightspodcast.com, or I have actually a step-by-step course where I walk you through how to find your property, do the title search, find your documents, locate your resources on a map and identify what's going on from what existing wells to permits and things like that. You can just go to mineralrightspodcast.com/courses to check out my mineral management basics course, where I walk you through step by step on how to do that. So I think in this situation, it does become important to know how to find your property, find out what's going on, and then also understanding, your lease terms. Right? If you just recently leased and there are some specific clauses in there that requires continuous drilling or other provisions where the operator has to drill in certain timeframes, you might be looking at more of that duck scenario where they're going to drill the wells. Maybe they're going to hold off on completing them because they want to hold your lease and other leases that they've negotiated in those really hot areas. So it's very specific on your situation. But, I think, again, doing the research and those resources we've mentioned so far can help you get a better picture of what's going to happen, so you feel informed and don't feel like you're just at the whim of the market. You at least kind of have a little bit of an idea where things are headed. And, obviously we don't know what oil prices are going to do exactly. That whatever this forecast is, I'm sure it's going to be wrong, right? This short-term energy outlook. And normally they have a price, and then they have a band of, here's what the high side is and here's what the low side is. And of course, with the government shutdown, they're not doing that. They published the price forecast, but they didn't publish those uncertainty bands. And so, all that this is saying is that $48 is probably not going to be the actual price we see next year. It could be lower, it could be higher, but the overall trend does appear to be down. So I think that's something to take into consideration, and then to plan accordingly.
Yeah, plan for the worst, hope for the best, man. That's certainly something in being a mineral owner that I've learned is a good way to handle the income, at least.
Absolutely. Yeah. And so I think that, again, do your research. We'll put all the links that we mentioned in the show notes. We can, look at these articles that we've mentioned, look at the list of operators and their price sensitivity. There was a really good article recently by RBN Energy and their blog around oil price sensitivity for some of the major U.S. E&P companies, and how much are they weighted on gas versus oil? How much, how much debt do they have? All those things, so you can sort of see for your operator, how it might affect them specifically. So all these things are great resources, and we'll link to in the show notes, so you can stay on top of what's going on and stay informed. And we will keep you updated in a future episode as we see how 2026 actually plays out.
You said it, Matt. Well, let's hope it goes better than they say, but definitely time to start planning it.
Absolutely. All right. Well, thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.